Prices picked up slightly in June, but largely in line with expectations. Joining me now to discuss is Apollo Global Management Chief Economist Torsten Slok. It's good to have you, Torsten. You have been one of the economists warning that tariffs are going to be inflationary, just not seeing it yet.
Hold on. This report does mark the liftoff in inflation. If you look at the subcomponents for tools, for toys, for apparel, for furniture, it's very clear that you're now beginning to see the effects of inflation in the goods part of the CPI index. So what's very clear is that companies built inventories going into the trade war, and those inventories are now being run down. And we're getting to a point where companies are now taking the new goods that they have imported with tariffs and passing that on to consumers. So this is, in my view, exactly what Jay Powell has been talking about, that he expects a meaningful rise in inflation. And I do think that this report today is exactly the start of that process.
For sure, you can see it in furnishings. And what you said, I highlighted some men's shirts, saw a nice tick up on the month. You see it in in very specific areas. But the headline number, it's not there. And that's in part because services, and we are a services economy more than a goods economy, is showing a slowdown in price increases. Shelter is such a major component of our cost of living, and that's coming down too. So when I say it's just not showing up yet, what I mean is in the headline number that would need the Fed to have to stay pat or raise rates.
No, you're right. I mean, there are other moving parts than, of course, what's going on with tariffs. And you're absolutely right, Sarah, of course, that we are a services economy. But the fear, of course, that you can have here, and which I think is very important in this discussion, is that there is so much momentum coming now on tariffs. And if we have the situation where companies are reporting that they're running down their inventories of goods that were at old prices, then now the new prices that we're seeing exactly includes tariffs. And with tariffs, of course, having gone up, and now we're approaching the level of April 2nd, tariffs again, then that might mean that over the next several months, and this is again what Jay Powell has been emphasizing, that we should expect to see a rise in inflation overall, because we will have the goods part overwhelming the declines that we are seeing on the services side. So the conclusion, at least still in my view, is that it makes complete sense what markets are pricing today, that rates are going to stay higher for longer. Two-year rates have gone up a lot on the back of this report, because the fear is that this is indeed the start of the process of inflation beginning to move higher.
I could see it both ways. I feel like if you're one of those on the Fed that is itching to cut rates sooner than later, i.e. Bowman and Waller and that camp, you look at this overall, you look at the super core over the last 3 months, up only 2%, and you say things are contained. And, the price increases are happening, just not on a widespread level, and they're not going to be sustained.
No, you're right. There is a healthy debate on the FOMC about this, but the fact that core goods, excluding autos, were up 0.6%, footwear up 0.7%, you have some pretty dramatic increases in a number of categories where you wonder, is this just a one-time shock, or is this the beginning of a much more substantial adjustment? And for the Fed, you're right. This is the debate. As you look at the moment at pricing, there is literally a 50-50 chance of a cut coming in September, but it's very clear that July is no longer happening. So that's why, of course, as we get more prints and as we continue to see this process play out, I do expect that the Fed's own forecast for inflation moving higher will continue to be one that will be playing out.
There's my graphic from earlier. Men's shirts and sweaters, 4% increase on the month. That was high. Women's dresses, cookware and tableware, appliances, and toys. So there's no question that certain categories are feeling it more than others, Torsten. But I guess the mistake would be if the Fed, was worried about the impact of this and waiting to see it show up in the headline numbers, would they miss then weakness in the economy that they could have gotten out in front of?
Yeah, and that is absolutely correct. As you know, of course, also, well, the good news is that the labor market is still relatively good, but the slowdown you've seen in private payrolls is certainly pointing in the direction of the other side of the dual mandate, namely the employment side, beginning to look a bit more weak. So you're right, this is the debate on the FOMC, namely how much weight should they put on this worry that inflation may be higher on the good side, and which would, of course, be saying that they should stay higher for longer, and how much weight should they be putting on the fact that the labor market could still be weakening, which, of course, would be arguing for the fact that they should be cutting. So that's why the dual mandate is creating this very uncomfortable debate in markets, namely, do they like apples, do they like oranges? And at the moment, today, the data point at least points in the direction of rates still being higher for longer.